Hi, this is Caroline Stephen, and this is Talking Trading. Property markets around Australia have boomed. Share traders are also property investors. Today, we look at the hot property market and the economic climate with economist Jonathan Barratt. And last year, I completed Cert 4 qualifications in mortgage broking. And so I also asked Jono questions on how to safely navigate the lending landscape. Here he is. Jono Barratt, hello and welcome back.
Welcome. Thanks for having me back.
Always lovely to have you back. Jono, the RBA has made an announcement. What is happening to interest rates?
Oh, look, it's whether you like it or not, I think interest rates will be moving up. When we really look, RBA announcement, first Tuesday of every month yesterday, came in and basically said that they will look to move on interest rates, but it's still a fair way away. They're still looking at that 2023 level, 2024. I think the market is saying it's a lot closer than that, and I think that's the concern that we have to look at, because I think other central banks around the world are starting to move. We do have the Fed announcement tonight on what they're expecting. We're expecting to see a lot more tapering, i.e. tightening of interest rates via bond purchases. So that means that money's getting tighter, and as a result of that, that's the forerunner for interest rates moving up. Australia still has very low interest rates, and I think our anticipation is that they will move sooner rather than later. So I would be a little bit cautious on sort of working out what I'm going to buy in the property market and how I'm going to fund it.
So that was my next question. What does this mean for homeowners and property investors?
Look, it is quite tricky. There's no doubt about it, Caroline, because you have property prices that have been fueled by this stimulus or this low interest rate environment for such a long time. And, and the banks have sort of relaxed their lending. So at the moment, more people have a lot more money out in the market at very, very low rates. So they've invested in real estate because that's the one that's been moving, and now things could be on the turn for them. So if you are sort of looking or in the market at the moment, you really have to prepare yourself for that tightening of interest rates, which means that the amount of money that you have to pay per month will probably start to go higher than what you've actually entered the market into. So you've got to prepare a little bit more of a budget, because those rates or the amount you have to pay back on your interest and principal will actually increase once the RBA lifts their interest rates.
Jono, you're an economist and a financial commentator, and you have an Australian financial securities license. What's the difference between an AFSL and being a registered mortgage broker in Australia?
Well, I don't think there's a big difference. I think the overarching is the fact that it's regulated. When you look at the mortgage industry, when you look at the financial services licenses, they're all in the same sort of category where they are highly regulated. And if you have an AFSL, you have to show that you've got the necessary experience and the capital to run a business and to be able to have the experience to advise people correctly. And I think that, to me, is why it's regulated. And also because it's a very technical game, and a lot of mums and dads always buy a house. So they need to understand what the risks are. They need to understand what they're getting into, what they're actually buying, and how they've got to fund it. The best way to do that is through someone who's a professional, someone who's regulated by ASIC. He's done his certificate for in finance and mortgage broking, for instance, and he's with a registered company that is either part of ASIC or regulated by ASIC, and also one that falls within the National Consumer Credit Protection Act. And that gives the buyer of the mortgage the fact that they've got someone that's guiding them through this whole process and outlining the risks that are involved in loaning vast amounts of money.
I have heard compliance officers say that the Australian mortgage broking industry is a semi-regulated industry at this stage. Would you agree?
No, although people would say it's semi-regulated, there are very hefty fines if you're doing the wrong thing. ASIC is highly regulated, particularly when you look at that retail market. And if in fact there are any concerns that you do have, you can always go to ASIC and put a complaint in. The mortgage broker or any financial advisor needs to do the right thing by their client. And I think what you will find, even if it appears to be semi-regulated at the moment, you will find that it'll tighten up. You will find that the advisors that you'd be talking to would be those people that have passed their exams and they're regulated by a company that's also regulated by ASIC.
Okay, let's talk about risk and position sizing, because in property, you're playing with the biggest position size of all, which is houses. How important is position sizing, Jono, in both the markets and property?
Look, I think when you're looking at property, these days you've got the lending requirements, criteria that the banks and finance institutions offer. Be guided by that. Always take a second opinion too, because the amount of money which you are loaning, you also have to be able to pay that back, whether it's an endowment mortgage where you pay the interest or principal and interest. You really need to understand that you've got that ability to pay that back, because if you do start to default, then they've got the right to take that property off you. So when you are looking at that position, just make sure it's affordable, make sure it is something that you know that you can finance. And I would also put a couple of scenarios together. I would say, well, given what my rate of interest is that I have to pay, what would happen if it went up by 1% or 2%? Can I still afford that? And to me, that is the key at the moment. As we're transitioning into another economic environment, a tightening bias, run your scenarios through and through again, so you know you can afford it. If you can't afford it, then you have to make some very, very hard decisions.
So who would you recommend you get a second opinion from, and who would you recommend would cross-check your figures or the figures that you've been presented with?
I think it's sort of in a funny way. You can do it yourself, but if you haven't, your accountant, just have a look at it and say, this is what I'm thinking of doing. A financial advisor should be able to help you. It's sort of, or even a friend that has a little bit of nous in terms of where I had loaned money before. I can remember when I first started in the property market, interest rates were at 17%. So I had to make sure that I could find that. Now, that was a very long time ago, but it also was a very interesting market because I had to make sure I could afford it. And that to me is the key. It's that planning that you need to do. Hopefully we'll never get interest rates to that level, but they were at that level a long time ago. I'm not going to say how long, but they were there. And then they just continued to come lower. But at this end of the range where interest rates are very low, it's very critical, I think, that people do their scenarios, test the scenarios. What would happen if interest rates moved up by 1%, 2%? Can I still afford it? Remember, we haven't yet seen wage growth. So this will go to the bottom line very, very quickly and hurt people if they haven't planned.
I remember this story from you that you had property at 17% and it was a big issue for you. Jono, can we talk about your views on leverage in property and the markets?
I think leverage is a double-edged sword. You really have to understand that leveraging. Understand that it works for you. And believe you me, a lot of people have made some very, very decent returns just in the last or during the COVID issue, because liquidity has been so loose. And if they haven't capitalized on, remember, markets go up and also can come down just as quick. So it always is that concern. So leveraging is good if you understand it. When I always look at leverage, whenever I look at a position, I say, what is the full value of the position? And then I look to try and halve it. And then I know that that's something I can afford. If the market does go against you, you have to then start to make those decisions. And they're tough decisions. But if you don't make those decisions, then in this case, the bank can come in and take the property from you and they will just sell it, and then you'll be left with the debt. So it's very critical to make sure you can afford, look for those signs. If it is your house, great, but you just might have to work harder to keep it.
And what do you say about equity release and equity release on places of residence?
Look, I think at the right level, it works. And I also think that we are living longer. If I were looking at equity release and I didn't have the finances to see through my pension, I think that is okay, but be very wary when you look at it. And I would only look at towards the tail end of my, not career, but when you're in your late 70s or 80s, if you really need it. But at our age, you really need to, I can say not our age, at any time, if you are going to do equity release there, you're leveraging yourself into something else. So that capital really has to work for you. So you really have to understand, what you're releasing and then what you are investing in. I mean, they're quite crazy. You can release equity to buy another property. Okay, we've got leverage again. So all of a sudden, be aware, do the maths, make sure you can finance it.
Okay, so let's talk about property prices during COVID. What's happened to them?
Look, it's been it's actually been a very interesting market. We haven't seen wage growth, okay, but we've seen the cost of money come down dramatically. RBA, we're talking about 0.1%. So, when you look at these sorts of things and you look at rentals, then you can easily afford it. So the property prices have moved quite quickly. And we're looking at about 18 months, where some places are looking at 20 to 30% gain. I mean, this is a phenomenal move. This is not real investing. In my mind, it's what we call a supernormal profit. If people take advantage of it, these sorts of returns just don't happen in such a small base of time. But they have been there to help support industry. We've had that looser monetary policy to help stimulate the economies when we've really should have gone through a contraction phase due to COVID. But this is all a very interesting place because people are taking profits, people are holding, but generally 80% of the people will always hold because it's their family home. It's more those traders or those people that are looking to speculate on the property, which will be the ones that might have to move.
Any advice, final words of advice for people who are speculating on property?
I think that if they understand, now, I think one of the interesting things is that when you are speculating on property, the whole industry has shifted one way in terms of its costings. To buy the asset, to redevelop the asset, and then to sell it, all these things, a lot more costings have come into it. So you really are working from your spreadsheet, and you've got to stick to that spreadsheet as much as possible. And it's those returns. I would also be very cautious at the moment, because we have moved from a loose monetary policy to a very dovish tone, which we're seeing from the RBA. And that would say that we're potentially going into a cooling off period in certain areas. And that cooling off period might last for a good 12 to 18 months. So I'd be cautious about investing at this time. But then, hey, look, if you always get a good return, or if you see a good opportunity and that opportunity is right, then it does make sense. But do the maths before you do it.
Jonathan Barratt, always a pleasure. Thanks for your time.
Thanks, Caroline.